Gold just crossed Rs 73,000 per 10 grams. Your mother's asking if she should buy for Diwali. WhatsApp uncles are sharing sovereign gold bond tips. But here's what nobody's telling you about timing India's most emotional investment. When the rupee crashes, Indians buy gold. When inflation hits, we convert savings to metal like our grandparents taught us. But timing gold isn't about standing in line at Tanishq during Akshaya Tritiya. It's about reading signals while everyone else is still checking yesterday's rates. Policy isn't abstract. It hits your wallet. As the RBI weighs growth versus inflation, decisions made in these halls ripple through banks, interest rates, the rupee, and finally gold prices. Learn to read these moves before headlines catch up. Rewind to 2008. Global markets collapse. Sensex drops 50%. The rupee weakens. And gold? Gold in rupee terms goes absolutely mental. From Rs 10,000 to Rs 29,000 per 10 grams in just 3 years. Your auntie who bought then is still bragging about it. 2013. Government panics about gold imports killing the current account. Slaps massive import duties. Gold prices spike because Indians don't stop buying. We just pay more. Classic supply squeeze. Then, 2020. Pandemic. Markets crater. RBI cuts rates to historic lows. Prints money to save the economy. Gold rockets past Rs 56,000. Everyone who said gold is outdated suddenly wants in. See the pattern? Economic chaos, weak rupee, RBI rate cuts, gold explodes. But here's where most Indians get wrecked. When RBI cuts repo rates, your fixed deposit returns drop below inflation. Your PPF barely beats rising prices. Real returns go negative. So where do Indians historically run? Gold. Property. That's it. Lower rates also mean weaker rupee against the dollar. Gold is priced globally in dollars. When the rupee slides from 75 to 83 per dollar like it has, you're paying more rupees for the same gold, even if global prices stay flat. Double whammy, double gains. But India's relationship with gold isn't just about returns. It's about weddings, inheritance, emergency funds your parents can liquidate when banks say no. That cultural demand creates a floor under prices that Western investors don't have. And unlike Americans who buy paper gold, Indians want the real thing. That physical demand. We're the world's second largest gold consumer. That's what drives prices during uncertainty. But here's the trap. Trying to time gold perfectly is where middle-class Indians destroy their wealth. Remember 2013? Gold hit as 32,000 and then crashed. People who bought the top because their neighbor was buying, they waited 5 years just to break even. Why? Economy recovered. Modi government pushed Make in India. Stock market rallied 300%. Mutual funds gave 15% returns. Gold just sat there doing nothing while equity investors got rich. The millennial mistake? Buying gold after prices already doubled. The smart money, the guys who bought at Rs 25,000 in 2015 when nobody cared, they made the real returns, not the crowd buying at Rs 50,000 because CNBC Awaz told them to. So what signals actually matter for Indian gold buyers? First, RBI policy shifts. When Shaktikanta Das moves from fighting inflation to supporting growth, rate cuts are coming. That's your cue. Second, rupee trajectory. When the rupee starts sliding past key levels, 80, 82, 85, gold in rupee terms accelerates even if global prices are flat. Currency weakness is gold's best friend in India. Third, monsoon and rural demand. Bad monsoon means rural stress, but also government stimulus. That stimulus, it flows into gold during wedding season. September to November, watch rural sentiment. Fourth, government policy on import duties. Every time they mess with gold duties, whether raising or cutting them, prices whipsaw. Budget day in February, that's when you learn if your investment thesis survives. And fifth, geopolitical chaos. When oil prices spike because of Middle East tensions, India's import bill explodes. Rupee weakens, inflation rises, gold becomes the only hedge that makes sense. But let's talk truth. Gold doesn't pay interest, doesn't give dividends. Jewelers charge making charges that kill your returns on jewelry. Even sovereign gold bonds lock you in for years. Financial planners say 10-15% of your portfolio in gold. Higher than global standards because we live in a more volatile economy with a weaker currency. It's not about getting rich. It's about not getting poor when everything else crashes. Physical gold for emergencies and tradition. Sovereign gold bonds for returns. Gold ETFs for liquidity. That's the evolved Indian approach. Not grandmother's jewelry locked in a locker earning nothing. Gold doesn't care if you bought at R30,000 or R70,000. It doesn't care about your uncle's WhatsApp forwards or that YouTuber screaming, "Buy now." It's been part of Indian culture for 5,000 years, and it'll be here when crypto crashes and startups fold. Do your research. Allocate smartly. Don't chase. That's how generational wealth actually works.